Hello, and welcome to this special edition of Eye on Bankruptcy. I'm Michelle Harner, a professor of law at the University of Maryland Francis King Carey School of Law, and your host. Eye on Bankruptcy is a monthly show produced by the American Bankruptcy Institute. The show airs on the last Thursday of every month at 1 p.m. Eastern Time. It typically features a leading practitioner and a judge discussing recent cases in the bankruptcy, restructuring, and commercial law fields. You also can earn up to an hour of credit for watching the show live, so I encourage you to tune in when this show airs on April 27th at 1 p.m. The show's website, eyeonbankruptcy.com, contains an archive of over 20 past episodes, which you can stream live at your convenience. Today's show is special because we're deviating a little bit from our typical format. We're not going to be discussing recent cases, but we are going to be discussing 3 industry sectors that have been particularly active in the bankruptcy and restructuring space. I like to think of it as energy, retail, and healthcare, oh my. To help me think through the issues that these sectors are experiencing in the current environment, I have 2 extremely experienced and well-known guests with me today. To my immediate right is Jason Bruckner. Jason is a partner at the law firm of Gray, Reed, and McGraw in Dallas. He has extensive experience representing companies, creditors, committees, dip lenders, just about every constituency that's involved in a Chapter 11 case. Jason's been especially busy in the oil and gas industry as it's been undergoing quite a bit of restructuring and bankruptcy in the last couple of years, and he's going to help us think through some of those issues. Next to Jason is Perry Mandarino. I know Perry well, we go way back. Perry is a managing director and head of corporate restructuring at B. Riley & Company in New York. He has been practicing for over 25 years, working as a financial advisor and CRO, and I think, gosh, at least over 300 cases, both in and outside of Chapter 11. Outside of Chapter 11, he works on the operational turnaround, and inside the Chapter 11, he works both on the restructuring and serves as an expert witness quite a bit as well. Welcome to you both.
Thank you. Thank you.
Before we jump in, I want to set the landscape just a little bit for the audience. So since 2015, there have been over 115 oil and gas cases. In just 2016 alone, 24 of those companies were public companies, and they had over $47 billion of debt. Not to be outdone, here comes retail. Retail in 2017 has seen at least 9 bankruptcies already. I think that's almost as many as all of 2016. And when you think about some of the announcements we've heard, Penny's, Radio Shack, Macy's, Sears, each have announced closures of over 100 stores. And Radio Shack, of course, filed its Chapter 22. Wet Seal and American Apparel filed Chapter 22s as well. And when we think about the human component of that trend, I read a recent statistic that said since October of 2016, 89,000 people in the retail industry have been laid off. Another industry not far behind is healthcare. Again, 9 healthcare bankruptcies in 2017 so far, and folks, we're not that far in. It's only mid-April. In the healthcare sector, we're seeing issues with the regulatory scheme, some uncertainty, and again, a huge human component, both for the patients, the communities, and the employees of those institutions. So some serious business, and it's always serious business for those of us in this profession. And I guess let's start with energy, since they've been really active probably the past couple years. And part of that, it seems to be driven by the volatility in pricing, right? We have deals that were done when oil was over $100 per barrel, and then it dropped, I think, to a low of $40 per barrel, maybe lower, and then it's been up and down, and then OPEC stepped in and was trying to stabilize the market, got above $53 per barrel recently. Now we're trending back down a little. From an outsider without any industry experience per se, and just watching what the market's doing, I can understand how that could really wreak havoc on a business model. So I guess, Jason, I'll come to you first. Is it the volatility in the market that's really caused the distress in the energy space, or are there other factors that we should be thinking about as well?
I think the volatility in the market was certainly, integral to what was going on, because as actually Perry and I were talking about earlier, a lot of these deals were done when commodities were at a very high price or were trending up. And through the trend downward and the bottoming out at the end of 2015, that had a huge impact on people's ability to do deals, cash flow positive, and otherwise service their debt.
So it brought a halt somewhat to the deal making. What then does the company do with the business model and the pre-existing deals that are in place? How have they gone about restructuring those kinds of obligations, and how have they used the bankruptcy to assist in that process?
Well, there's been a lot of cost cutting, as you might expect, both pre-petition and post-petition. Many of the cases that have filed, we've seen there have been a variety of pre-packaged deals, and there's also been many pre-arranged deals where there have been restructuring support agreements entered into prior to filing that have oftentimes the fulcrum security folks have taken the ownership interest in the new company coming out. And that's really been the trend. There's been a lot of, aside from restructuring support agreements, there's been a variety of backstop agreements and rights offerings and people putting in new money to enhance their equity interest on a go-forward basis.
So would you say that most of the oil and gas cases we've seen in the last 2 years have been able to restructure and move on as a going concern, or have we seen some liquidations or 363 sales as well?
There have been a variety of 363 sales. There's been a bunch of restructurings. There's been several Chapter 22s. Vinoco just filed again. Hercules Offshore filed for a Chapter 22. So some of the restructurings have been successful, some not so much. Ultra Petroleum actually was a very successful Chapter 11. They came out, and their borrowing base was just increased by $200 or $300 million because of the price of oil and the new structure that they have in place. So there's been a spectrum of outcomes in these cases.
Which is better than we can say for some industries where we've seen a growing trend in one direction. So I'll open this next question up to both of you. So when you're reorganizing or restructuring a company in Chapter 11, as we like to see companies do, how do you account for and try to stabilize the volatility in the market, and how are you thinking about valuations?
Sure, and I think what happens is how you allocate the value that's established. So you have a commodity, it fluctuates. I mean, oil went up to, the high 50s, the 60. It's down back to about 49.50. The low was actually, in the 20s. Mm-hmm. So you have to allocate value appropriately, and that's the biggest challenge. You have these different creditors with different complex capital structures. Who is the fulcrum, right? There is a fulcrum, but is it the most senior lenders, the first liens, the second liens? And so that's where the battles come out, but it's allocating that value is a huge challenge.
And again, just being an outsider and watching what's going on in the oil and gas space and the valuation challenges and thinking about allocation issues, one of the issues we struggled with when we did the Chapter 11 commission to study reform was how to allocate value through a plan when there was potential upside, right? And in a lot of these oil and gas cases, there could be potential upside depending on what the market does. Have you seen any of the cases trying to deal with that, or is that really where the tension lies in trying to get to that confirmation?
It's really a source of the tension because as valuation, you have to pick a date. So it's right. The date of confirmation or whatever the date is, that's the valuation as of that time, and your valuation metric should have assumptions for how that growth will be. It's high risk because what happens if OPEC decides to just flood the market again, right? It's high risk.
And to that end, there's been a trend in energy cases lately where you've been seeing either official or ad hoc equity committees that have been very active in both the Southern District and in Delaware and in New York. And so the equity holders have been driving, of course, higher valuations based on higher strip prices coming out, a year, 2 years, 5 years, what have you, to try to recapture some of that for old equity instead of seeing it evaporate the way you might normally see it evaporate in a Chapter 11 case.
And that's certainly a unique feature, right? Seeing an equity committee in most any case is rare, but I think you're right. I think we're seeing an uptick of the equity committees in this space. Other trends or emerging issues you're seeing as the oil and gas cases are now moving through the system?
Well, I mean, there was just some reports last week and the week before leading up to the conference. In the first quarter alone, there's been almost $20 billion in private equity money that's been raised for investment in the oil and gas sector, or in the energy sector, I should say, as a whole. So I would say generally it appears as if from reading what's in the press and what's going on, people are bullish on what's coming up. Citi is projecting oil as high as 65 by the end of this year, and OPEC is expected to be targeting $60 oil by the end of the year. And as costs are cut and technology advances, exploration and production companies, E&P companies, are going to be able to cash flow positive at a lower price of oil and gas. And so as prices creep up and as technology advances, I think you're going to see people not being as affected by the price of the commodity as they had in the past.
So for this audience, who I think we always have an interesting perspective on when markets change, is that good news or bad news? Are we seeing now an end then to the filings in the oil and gas space, or?
I'm not sure it's gonna end.
Okay.
I think it's gonna trail off a little bit, and I'm no great prognosticator, on the score.
You're
But
just among friends. We're just talking.
biggest group of friends I've ever had. I think, look, I just saw a report, there's a large number, 20 or 35 energy companies have now drawn 70% or more of their available credit under their credit facilities, expecting that perhaps there will continue to be some bumps in the road. Certainly the companies that don't have the right cost structure in place and don't have the available technology at their fingertips are going to still be hampered by the lower pricing in the commodities area, and they're going to be hampered by the inability to cash flow at a lower price. So I think there will continue to be restructurings, there will continue to be bankruptcies, maybe at a lower rate than we've seen them, but they will be there until oil and gas really takes a big jump, I think.
And you mentioned Vinoco, which recently filed again, and I think this time, I think it had merged maybe in August of 2016, refiled just recently, April 17th, and has announced, I think it's going to liquidate.
Yes.
Do you think we'll see more of those kinds of 22s where they came out as a going concern but now have to close the doors? Or is that kind of a blip in the way the energy sector's been reorganizing?
That's actually really hard for me to project. I think it really just depends on the nature of the beast and how the restructuring went. A lot of it, for example, there's a case right now that we're involved in Houston where the borrowing base is really driving the negotiations. What is the first thing lenders' borrowing base is going to be? It's going to be $850 million. It's going to be $1 billion. It's going to be $1.2 billion. And depending how that plays out and how the other negotiations play out, could very well have an impact on the future operations of this entity as well as others, and whether they wind up filing for 22 or liquidating or selling off assets, after Chapter 11 the first time around.
Absolutely. Okay, so Perry, I'm going to come over to you, and I think that segue of thinking about what kinds of bankruptcies we'll see in oil and gas going forward, it's a nice time to think about retail. And I want to start with a statement I saw recently. I think it was in a Market Watch article from March, where they said from a risk of filing bankruptcy perspective, retail is the new oil and gas.
Yeah.
Right? Orange is the new black. Do you think that's true?
From that perspective, in terms of number of cases, absolutely. But in terms of the exit, I think the better analogy of retail is the real estate market. Oil and gas companies predominantly will come out. Some of the oil field services that just couldn't live on, they couldn't wait, they've gone away. So when you think about retail, it's more like homes, it's more like real estate. So you have, and let's break retail up into different components, because not all of retail is dying. But you have mall-based stores, specialty retailers, you have department stores, you have grocery stores, you have discount stores, restaurants. So I think where the real, and because it's what's happening and what I think will happen, it's in the mall-based specialty stores and in the in some department stores. So why is that? Similar to real estate, there was overbuilding.
Yeah.
There were just too many. When you look at women's fast fashion apparel, there were something like 23 stores, 23 brands that had over 300 or close to 300 stores or more. It's not all needed. The change in consumers' attitudes and what they want to spend money on is totally changed. They can't all survive. It's retail Darwinism. The strong brands that have been proactive, that have reduced their footprint over the past few years will survive, that aren't over-leveraged, that haven't done LBOs. There was an incredible amount of private equity money that went into retail, highly leveraged companies. Some will certainly survive. The larger chains that could reduce their footprint, that have a good operating model and strong management. The other stores that are, the 300-store chain that are highly competitive, it will be very difficult for them to survive, and there have been many, many liquidations in that space already. As you said, the number of retail filings with over $50 million in liabilities has exceeded last year. The number of doors closed is 2,800 doors through the first quarter. My personal prediction is that there will be another 10,000 doors closed in the next 12 to 18 months.
So Perry, you hit on some really important points in that summary, and I want to draw some of those out. So first you talk about the overbuild. And so you think back in the day, right, in the late 90s when we were building the Mall of America, right, which I recently read, you can fit 9 Yankee stadiums inside the Mall of America. That's just crazy. What does a retailer do that has that large footprint you're talking about? Can they use an out-of-court restructuring to try to reduce that? Is the bankruptcy tool useful in that space?
The bankruptcy, and when a retailer files bankruptcy, unless there's a plan in place, there is one constituency that is, I think, underrated in determining the success of retailers, and that's the vendors. Because if the vendors don't ship when the company files, if they're concerned that there will be an administrative insolvency, it is almost fait accompli that the retailer will close, because retailers constantly need to bring in inventory. And unless there is a plan that almost a quasi-pre-pack or pre-range that could give the vendor the insight that they will be made whole, it's the court process is not always the best option. An out-of-court process, which we're right now doing for a client, is we're trying to negotiate with the lenders with the landlords to take the equivalent of their year claim that they would have under bankruptcy, and then restart the company with its brand, which is a strong brand, and it has some other assets. So it's a matter of what are the other components of the retailer. And I know the big interest in the question you have is the 2005 amendment, right? What is the impact? I think the 270 days is a less impact today than it was maybe at the beginning after the code was amended. I think what really is hurting retailers in the ability to reorganize is 503b9. Right? I mean, to me, I'm not a lawyer, but bankruptcy is binary. You're in it or not, right? And same thing with preferences for vendors. If 503b9 and 547 for vendors only went away, I think it'd be a good thing, because the 503b9 puts an incredible burden on maintaining administrative solvency. And the point I made before about getting the inventory in, it's critical.
Well, and I think different people have different perspectives, right, on the 2005 amendments. And believe it or not, I think there's even some people who like it. I know, thinking back through, I should say I was hoping to get a laugh. You guys must be in your kind of lunch coma today. I was thinking back through the commission study we did, and we focused a lot on retail, not the 2005 amendments per se, but how could the bankruptcy code work better for retail? And looking at the transcripts from the Circuit City case, for example, there was a lot of finger pointing. It's the vendor's faults, it's the landlord's faults. And when you think about the 2005 amendments, they each got a little something in there. But it really does, to your point about trying to negotiate the consensual restructuring out of court, come to the fact that there's a number of moving pieces in the retail space. The code's probably not working well for several of those, which is forcing the retailers to look to that out-of-court restructuring.
Yeah, and the code is really one of many. There's really a confluence of events that's hit retailers. It's certainly the changes to the code, but it's e-commerce and dealing with e-commerce. It's pricing. There is deflation. There are some stores, some chains, whose volume has maintained, but their same-store sales are less because of price, which is unheard of, right? I mean, deflation in retail, in apparel especially. It costs less to buy a pair of pants at Ann Taylor today than it did 10 years ago. I mean,
Right.
Just think about that.
Well, and so, in your opening summary on retail, you talked about the footprint and the large footprint, but you just now highlighted several key points again that you mentioned earlier. So e-commerce, I read somewhere that e-commerce is growing by $40 billion on an annual basis.
Yeah.
That's a huge number. And, purchasing practices of consumers have changed. Apparently, we like to spend time with each other now. We'd rather spend our money going out to dinner with friends than on material things. And so when I think of the challenges that a retailer faces, we were talking about market volatility with oil and gas. For a retailer, there's so many shifting platforms for it, from having to transition its brick and mortar stores to a more online platform, to figuring out what the consumer wants, and we're a tricky bunch, to having to deal with the different segments you talked about, right? Your discounters, your mainstream, your high-end, your outlets. How are you helping companies through that quagmire?
Right, so we have to ensure that it's managed well, that the cost side is taken care of, but a lot of costs have been taken out. What the issue is that you made the point, we buy differently. The traditional advertising on TV and in newspapers is certainly a smaller component. I mean, Amazon has changed the world of advertising, right? And how to reach the customer, and you have to have a very good loyalty program. I mean, there are some stores that 70% of their volume goes through people who are in their loyalty program. Mm-hmm. It's reaching out to the customer. It's having a reason to go there. Brand is less than it used to be. It's still important, but it's less. So you have to have a good price and a good product because there's just so much competition.
So in addition to dealing with the traditional restructuring issues I think we think about on the finance side of the equation, the operational issues facing retailers I think are huge.
Yes.
But now thinking about going back to the bankruptcy code, since we're at a bankruptcy conference, we have seen a trend. When a retail files a bankruptcy case, it's not pretty. It's usually a liquidation or some kind of 363 going concern sale where the company, yes, comes out, but looks very different.
Yes.
Why do you think that is, and is that going to be where we continue to go with retailers?
I think so. Again, bankruptcies have to be very quick for a retailer because they just can't sustain losses. In the time of year that it files, it's important because there are many stores that are really dependent on the holiday season, that they're dependent on back to school, that are dependent on Father's Day and Mother's Day.
Right.
So it's quick, and I think the trend, my belief is that you will see very quick 363 plans with, if there's a lot of leverage and the fulcrum is converting to equity. I think there will be a lot, first days with the 363 bidding procedures filed on day one, or I think you're going to see a lot of liquidations on day one. There will be exceptions, obviously. But in my opinion, and what we're seeing is the predominant, what the courts will see will be very quick sales and quick strikes because they just can't afford it. They can't afford to stay in. Leverage is really bad for retailers.
So I'm an optimist. I like to try to be an optimist. So I'm going to see if maybe something that Jason said in the oil and gas space, where we've seen the use of pre-arranged and pre-packaged plans, are any of those out-of-court consensual deals that are trying to be orchestrated among the retailers, the landlords, the vendors, possibly going to benefit from pre-arranged and pre-packaged plans, which at least gets us closer to a restructuring where you may have a sustainable business on the other side?
Absolutely, and I think that will happen in the larger 1,000-store plus retailers that have a complex capital structure where there could be a deleveraging event where the second liens or the term loan or the first liens will convert to equity. And I think a prepackaged or pre-negotiated plan is a tool that should and will be utilized.
Okay, so we have maybe some leveling off in oil and gas, but still business. We have an uptick in retail bankruptcies, but perhaps not reorganizations, but we can hope, right? So I'll be the optimist and I'll hold out hope that we can actually reorganize these companies leaner and meaner and stronger. Let's go to our last segment, and that's healthcare. And healthcare is tricky, right? Because some of them can be Chapter 9 cases. You have the overlay of federal and state regulation on the healthcare industry. And so maybe in the little bit of time we have left, thoughts on issues the healthcare providers are facing when they're distressed and whether the bankruptcy tool is working for them.
And I think in healthcare, the main, so healthcare has a lot of different components, but when you look at distress, I think it's probably in two. That's providers, hospitals, and medical device companies. Some pharma as well. There's, again, a confluence of events that happens. You have the Affordable Care Act, which everyone now has gotten used to. Will that change to some other type of regulation? A lot of hospitals have already done the cost cutting, and so it's a top-line problem, similar to retailers, right? It's a top-line problem. So what else is happening is that certain states are being very proactive. The big health insurance companies in certain states are being proactive. So, for example, in New Jersey, where I live, the Horizon Blue Cross, the largest insurer in the state, has basically put hospitals into Tier 1, 2, and 3. And the reimbursement rates are different among those different tiers. So if you're in Tier 1, you get paid more to treat the same illness that someone in Tier 2, and Tier 2 more than Tier 3. So again, it will be survival of the fittest, and it is incredibly complex. The working capital for hospitals is very it's very deep. So what's been happening? There's been a wave of mergers. Right. There's been number one. Number two, there's been a wave of community hospitals bought by for-profit hospital chains, which have the benefit of economies of scale, right? So what's happening is you have an impact on the community, an impact on the people, and you know I was involved in it was a Chapter 11, but it was a municipally owned hospital because the management company was a not-for-profit and not a municipal hospital, but the municipality of Hoboken, New Jersey owned the license of the hospital, and there was a lot of debt, and if that debt wasn't defeased, it could have had an effect not only on the city of Hoboken, but on Hudson County and on the state of New Jersey, right? So there's so many complex issues that happen, and that ultimately was a very successful restructuring through court, which was sold to a for-profit hospital.
Right. Well, you know, it's interesting. I think there's always a human component to Chapter 11s, but in the healthcare space, I think the constituencies impacted by the distress are broader and perhaps oftentimes closer to home. Also, of course, for those of us that think about consumer bankruptcy, the ACA and the healthcare issues are very prevalent in the consumer space as well. Well, unfortunately, that's all the time we have for this special segment. I want to thank my guests.
Thank you,
And I want to thank you for joining us today. I also want to thank all of you who have been faithful watchers of Eye on Bankruptcy for for viewing the shows over the past several years. So I started hosting Eye on Bankruptcy in October of 2015 at the NCBJ, for those of you who were there. And this is actually my last show, so I'm honored you could be part of that, and I'm so glad to have had the opportunity to speak with you. But for those of you who don't know, I will be transitioning to the bankruptcy bench in the District of Maryland. So I'm very honored and excited about this opportunity to serve in this new capacity. I will miss hosting this show. I can't tell you how much I've learned doing this show and how much more I've come to appreciate everything you all do on a day-to-day basis. But now I will become an observer, a loyal viewer of the show as well, because Eye on Bankruptcy will continue every month, the last Thursday, 1 p.m. Eastern. Watch this last show next Thursday, 1 p.m. on April 27th. And stay tuned to the ABI, who will have a very special announcement about the next host of Eye on Bankruptcy. It's in place, and it's going to be terrific. So I can't wait to see it, and I hope you will watch it as well. Thank you. And then Sam told me to remind you, next session, 2:15. Be there.